Hello and welcome to the channel. When we talk about investing, stocks usually steal the show, right? All the drama, the big gains, the headlines. But there's another side to the market, a quieter, steadier side that's absolutely essential for stability, income, and your overall peace of mind. I'm talking about the bond market, but let's be honest, buying bonds can feel confusing. Should you buy a bond fund or maybe individual bonds? What on earth happens when interest rates start to change? It feels complicated. Well, there's a classic, time-tested strategy that solves many of these problems. It gives you control, predictability, and protection all in one elegant system. It's called bond laddering, and it's one of the smartest tools any investor can have in their fixed income toolkit. Whether you're saving for a goal just around the corner, trying to generate reliable retirement income, or just want to reduce the scary ups and downs in your portfolio, this strategy is something you need to know about. So today, let's build a ladder. To truly appreciate why a bond ladder is so effective, we first need to understand the problems with the most common alternative, the bond fund. Think of something like BND, the total bond market ETF. Bond funds are super convenient and diversified, which is great. But they have one critical characteristic: they never mature. You just own shares of a fund that is constantly buying and selling bonds in the background. This exposes you to key risks, especially when interest rates are rising. First, there's interest rate risk. When new interest rates go up, the price of the older, existing bonds inside the fund goes down. This means your bond fund's share price can and will decline. It can sometimes be a significant drop. You can actually lose principal, which totally defeats the purpose of holding safe bonds for a lot of investors. Second, there's reinvestment risk. This is the risk that when the interest payments from the bonds come back to the fund, that cash has to be reinvested at whatever the current rates are. So, in a falling rate environment, your income could actually shrink over time. A bond ladder is specifically designed to manage these two big risks. It gives you the best benefit of individual bonds, which is the promise of getting your principal back at maturity while also providing the smooth income and liquidity you might get from a fund. So, what exactly is a bond ladder? Imagine a literal ladder. Each rung represents a bond with a different maturity date. A bond ladder is simply a portfolio of individual bonds. They could be CDS or Treasury securities where the maturity dates are evenly spaced out over a set number of years. It's like building your own financial escalator. Here's how you'd build a simple 5-year Treasury bond ladder. You'd take your total investment amount and divide it into 5 equal parts. Rung 1, you buy a Treasury bond that matures in 1 year. Rung 2, you buy a Treasury bond that matures in 2 years. Rung 3, you buy a Treasury bond that matures in 3 years. Rung 4, you buy a Treasury bond that matures in 4 years. And Rung 5, you buy a Treasury bond that matures in 5 years. You've now invested an equal amount of money in each rung of your ladder. Now, let's watch the magic happen over time. At the end of year 1, that 1-year bond matures. You get your full principal back, plus your final interest payment. Now, what do you do with that cash? This is the most important step. You reinvest it at the very back of the ladder, buying a brand new 5-year bond. Then, in year 2, the original 2-year bond, which is now just a 1-year bond, matures. Again, you get your principal back, and you reinvest that cash into another new 5-year bond. This process continues every single year, like a financial conveyor belt. You always have a bond maturing soon, which gives you liquidity, and you're always reinvesting at the longest end of your ladder, which lets you capture the most current long-term interest rates. This simple structure gives you 4 powerful advantages, or what I like to call the superpowers of the ladder strategy. First is predictable liquidity. This is the no panic feature. Because a bond on your ladder matures every single year, or even every 6 months depending on how you space it, you always have a known amount of cash coming due in the near future. This is absolutely perfect for funding known expenses, like your annual property taxes, college tuition payments, or systematic withdrawals in retirement. You don't have to sell anything at a potentially bad price. The money simply comes back to you right on schedule. Second, you get smooth interest rate risk. With a ladder, you are never locked into a single interest rate for your entire portfolio. Each year, as you reinvest the maturing rung, you capture the current market rate. In a rising rate environment, This is a huge benefit. Your overall portfolio yield will gradually increase as you add new, higher-yielding bonds. And in a falling rate environment, you're protected because you still have those older bonds locked in at what are now attractive, higher rates. It smooths out the ride. Third, and this is crucial, you get the elimination of principal risk as long as you hold the bond to maturity. If you buy a high-quality bond, like a U.S. Treasury, and you hold it until its maturity date, you are guaranteed to get your full principal back, barring a government default. The price fluctuations that happen in the market day to day, the ones that plague bond funds, that just don't matter to you because you have no intention of selling. Your ladder turns all that price volatility into mere background noise. And fourth, you get a combination of a steady income stream plus your principal returned. You receive regular interest payments from all the rungs on your ladder, which provides a nice, steady income stream. Then, as each bond matures, you get a big chunk of your principal back, which you can either spend or reinvest to keep the ladder going. This combination is ideal for retirees who need both income and access to their capital. So, how do you actually build one? For beginners, the safest and easiest way is to build a treasury ladder. You can buy treasury securities directly and commission-free from Treasury Direct Gov, or you can do it right through your brokerage account. A great place to start is with a simple 3 or 5 year ladder. Just allocate an equal amount of money to treasuries maturing in 1, 2, 3, 4, and 5 years. The most important part is to set a calendar reminder for when each one matures, so you remember to reinvest it. So, let's do a quick recap. The problem we're solving is that bond funds expose you to constant interest rate risk and price volatility, which can lead to principal loss. The solution is the Bond Ladder, a series of individual bonds with staggered maturity dates. The benefits are huge. You get predictable liquidity, you reduce your interest rate risk, you protect your principal if you hold to maturity, and you create a steady combination of income and returning capital. Look, a bond ladder isn't sexy. It's methodical, it's mechanical, and it's beautifully predictable. It's the exact opposite of stock market excitement, and that's precisely its purpose. In the part of your portfolio that's dedicated to safety and income, excitement is the enemy. Predictability is the goal. Think of it as building your own personal, predictable pension system. One rung at a time. Thanks so much for watching. If you found this helpful, please hit that like button and consider subscribing for more content on smart, practical investing strategies. See you in the next video.